Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with Carol Massar, a non-smiling Tim Stenovic. Welcome to our audiences across Bloomberg Television, Radio, Originals, and our partnership with YouTube. Carol, last time we spoke, I was saying that it looked like this market was actually kind of ready to punch into the green. We've drifted lower, and right now, we're right near session lows across the board.
Yeah, we're just talking to Paul Christopher over at Wells Fargo Investment Institute, and he said it really is kind of a news-driven market, and it can change at any moment. It just feels like the tone of the market has changed a lot, and whether it's, news about concerns about banks, we've seen that play out in the market, whether it's concerns about inflation or energy prices, it feels like the news momentum, it can change from hour to hour.
I mean, speaking of tone, his tone with us was one that was, really defensive, really, I don't want to say pessimistic, but really cautious. I mean, they're still calling for a recession at Wells Fargo.
Not like 2008.
He said not like 2008. He said even later this year or early next year. He says consumers are really strained right now.
Yeah, there's a lot of commentary about how we still haven't seen the full effects of all these interest rate increases, and it's going to start being felt later on this year. But we've heard that for all this year as well.
Yeah, absolutely. And I think, maybe there is a bit of a holding pattern here as people really do want to see that CPI report tomorrow morning, whether that you get that reacceleration in inflation that some people thought, or whether that downtrend continues. And of course, whatever Fed commentary gets baked into it after we go. We should point out that we did actually open higher on the S&P 500, only by a fraction of a percent here, and never really moved much off of that. At one point on the day, we were down by about 0.9%. It looks like right now, as we get the closing bells, we're going to close lower by 0.7%, down about 32 points, or about 44.67 on the S&P. The Dow Jones Industrial Average down about 200 points, or 0.5%. And we should point out the Nasdaq Composite down 1% on the day, but the Nasdaq 100 also moving lower here on the day by a similar amount and breaking below that 50-day moving average, first closed below that 50-day moving average since March of this year. The Russell 2000 also lower on the day, Carol, by about 0.9%.
All right, and as expected, a headline crossing the Bloomberg terminal. President Biden signing an executive order limiting U.S. investment in some Chinese firms. It's all part of a push to restrict the country's ability to develop next-generation military and surveillance technologies that might threaten U.S. national security. Scarlett, we continue to see the tensions really rise or kind of stay consistent, if you will, between the U.S. and China.
Right. As long as it moves in this direction, I guess it's all priced in, because people had anticipated some kind of action here. What would be a game changer is if suddenly there was a return to some sense of amity between the two countries. Let's take a look at the industry group performers here, because you've got energy stocks at the very top there. They've been the outperformers all day long as oil prices climb towards $85 a barrel. Telecommunication services, there we go, up 2/3% as well. On the downside, the chip makers, notably NVIDIA, has been a big drag, off by almost 3% as a group, and autos also a big laggard too, almost down by 3%.
All right, folks, to some of the individual gainers as we await those Disney earnings. Got to talk about Penn Entertainment rallying up about 9%. It was up as much as 18% earlier in the session. We know the news after the close yesterday, signing that $2 billion U.S. online sports betting deal with ESPN. And so it really got a kick to the upside. So, of course, we'll wait to see if we hear more about that on the Disney earnings release and call. I do want to mention Celsius Holdings up 20% in today's session. The energy drink company posted second quarter profit and sales that topped expectations. Stock is up about 70% year to date. And I do believe, I know it was an all-time high on an intraday basis, but you got about 21% of the float is shorted. Let's go to, if we can, to some earnings, because Wynn Resorts is just crossing the Bloomberg terminal. Macau, their revenues there will be really important. Second quarter adjusted EPS, folks, it's a big beat, 91 cents a share. The estimate was for 62 cents, so 29 cents higher than what the street was expecting. Second quarter operating revenue, $1.6 billion. That too is better than the forecast of $1.53 billion. Adjusted property EBITDAR, it was 524.5 million. That was a beat over the 456.5 million forecast. And second quarter Las Vegas operating revenue, 578.1 million. 587.2 million was forecast. So that's a little bit light, but nonetheless, that stock is up almost 3% here in the after hours. And we'll wait to see if we get, guys, some numbers when it comes to Macau.
All right. We're still waiting more earnings, notably Disney. In the meantime, let's go through some of the decliners. The notable decliners, there were no shortage to choose from. Scarlett, you hit the nail on the head when talking about the chip makers being under pressure today. NVIDIA finishing the day down by 4.7%. Semiconductors taking a hit. This after shares of Super Microcomputer fell by more than 20% after it posted results. Also, WeWork down 38.5% today. Wow. This is after the company yesterday, after the market closed, saying that there's a substantial doubt of its ability to continue operating. It's lost 98%, Carol, of its market cap since it went public. I mean, this was the darling of the startup world back, in 2017 when it had a valuation near $50 billion, and now it could be, a substantial doubt that it could continue as a going concern. It absolutely is. Questions, too, about what it does to commercial real estate here in New York City and many other cities that it has long-term leases in. Lyft shares down 10% today. The company did report its slowest revenue growth in 2 years, actually overshadowed a better-than-expected outlook. We covered it late yesterday when the company did report earnings, and everything that it's trying to do to get riders back to taking lifts once again.
Yeah, let's take a quick look at what's going on in the yield space. A bit more muted price action there relative to some of the other markets out there. You did see a downtick in yields on the longer end of the curve. The 30-year yield down about 4 basis points. Similar story for the 20-year and 2 basis points on that 2-year. However, you did see an uptick in yields on the shorter end of the curve with the 5-year up by about 1 basis point and the 2-year up by about 5 basis points, Carol.
All right, so let's get to, what do we want to talk about, guys?
Well, here, I'll just jump in here, Carol. Yeah. I do want to get just highlight Trade Desk. I know we're waiting for some earnings out of Disney, but we were talking a little bit earlier about the digital ad space. This on the back of some interesting commentary about what's been going on with PubMatic and a few others. They just came out with their earnings. Those shares down in after hours trading here. Now, the 2Q numbers did come in above estimates, both in terms of EPS and revenue, but the 3Q numbers look like they come in a little bit light, and that's raising some concerns about advertising writ large, advertising softness that could affect Disney as well. Walt Disney actually out with its earnings right now. Let's go right to that and take a look here at what we learned. For the fiscal third quarter, let's start off with Disney Plus and the subscribers that it has in the third quarter. A miss. 146 million subscribers to Disney Plus. The street was looking for 155 million. So that's a miss. Adjusted EPS coming in at $1.03. The street was looking on average for 99 cents. So that is a beat. Revenue overall for the fiscal third quarter, $22.3 billion. That's pretty much in line with what the street was looking for here. We have to, of course, we know, guys, go through all these different segments here to get a better sense here of what is going to happen with the company, and we're not getting a forecast just yet. So it'd be interesting to see how this all breaks down in terms of the strategy going forward. I know, Carol, you've already patted Bob Iger on the back for a job well done, but he's still got a lot of work ahead.
He's got a lot, and certainly people are going to be asking questions still about streaming, right, where they've lost a lot of money. He is trying to do a lot of things. He's trying to buy back all of Hulu. I'm looking at the press release. Bob Iger making some commentary. He says, in the 8 months since my return, these important changes are creating a more cost-effective, coordinated, and streamlined approach to our operations. So he says these results are reflective of what they have done, and they're talking about this transformation.
Well, let's get back to a couple things that investors are looking at with regards to the losses in that direct-to-consumer business, basically the streaming business. They're basically saying that the direct-to-consumer operating loss was $512 million. Believe it or not, that's a smaller loss than what the street was looking for. They were looking for a loss of about $778 million. The company also says that it took a charge in the fiscal third quarter of about $2.4 billion on content removal from its direct-to-consumer operations. Not exactly sure what that means here, but we do know that Bob Iger has talked a lot about getting costs in line with what he thinks is going to be commensurate with better growth here. So maybe this is a sense here of where he finds some of the fat, Scarlett.
Right, and the cost cutting is to the tune tune of $5.5 billion. And Bob Iger mentions that, saying that they're on track to exceed the initial goal of $5.5 billion in savings. Just keep in mind that for the quarter gone, there are a couple of other one-time charges that are going to hurt the bottom line, including the write-off tied to shutting down the Star Wars-themed hotel at Disney World. I mean, that was an expensive venture. There was also the weaker U.S. box office overall. There seems to be some fatigue around the Marvel and Lucasfilm properties.
Right.
The Indiana Jones movie didn't do all that well. I liked it, but not enough people
You
liked
went and
it.
actually saw that?
I did.
Oh, okay.
It was,
So you were the one.
Scarlett, you should have gone a few more times.
Because I
guess
literally
so.
think it sold like about $27 in tickets.
Guys, I still can't get past the Disney Plus subscribers for the third quarter. I mean, this is a major miss, coming in at 146.1 million versus estimates of 154.8 million.
Yeah.
How is the company not only going to get subscribers back, but also cover the costs that continue at its streaming division? I mean, this is one that is so important to it.
Well, that's what I'm curious about, because all the talk here is about the cost cutting, right? The idea that you spend less on content. Obviously, you have the writers and actors strike, which is going to limit that as well. But as I'm sure everyone knows, is that the value proposition, at least for a customer, is that there's got to be a fire hose of content. That's what made Netflix Netflix. If the content isn't there, why am I going to continue to pay?
I want to know about this 2.4 billion for content removal, because that's what's interesting. I'm looking at, they're talking about these restructuring and impairment charges related to the removal of content from our DTC services. You talked about this. Termination of certain third-party license agreements for the right to use content. So I want to kind of know about this, because as you guys say, it's all about content, right, to get us there.
Yeah, I mean, I hope people like reality TV, because with the writer's strike, that's what we're going to see.
Hey,
Really?
Yeah.
Oh, gosh.
by the way, the
gonna
stock,
see.
which
Or you
is
could just watch,
down-
or what about news, Tim?
this is reality TV.
Okay.
You only need Bloomberg for news.
Does Carol know she's on camera?
I know. I move around a lot. I'm a mover. The stock is just down about 2/3%. So we're coming off some of our lows. So it feels like we're trying to make sense of what it all means. All right, we got to go. All right, that's a wrap. More to come, though, on both sides. TV, radio, originals, and, of course, on YouTube. That's a wrap, though, for Beyond the Bell.